All right, guys, if it's 11 o'clock Central on a Tuesday, most likely I'm here. So another quick sound check, screen check. Seems like we're good, good. So let's go into the beginning unofficially of fall, the end unofficially of summer, the other side of Labor Day when volumes return. If it was the typical summer market, we'd get busy in September, October, but it wasn't a typical summer market. That's the title of today's meeting. What summer markets? I get asked all the time ahead of June, July, August, it's going to be a summer market. Is this summer market? And then in December, is this a holiday market? And historically, they are. June, July, and August are vacation months. So people in this industry are gone. Therefore, volumes are low and markets are in tight ranges and are really quiet and slow and boring. And get yourself in trouble if you're not prepared for that. But anytime there's a driver going into or during the summer or into December, the markets will be busy. It all depends on what's driving the damn market. That's why in every trading room session, we talk about what's driving us. And over the summer, it was US China, right? For the most part. If we take a look at the summer markets and just a daily, let me scrunch this up. Here, take a look at this. June is down in here in the S&Ps trading 2730. Remember that relief rally we had that the Fed was going to cut, and they started to price that in late May, early July, or late May, early June. They rally them all the way to 3,000 in this subcontract, right? 30.25. Then all the negativity from not only the trade war, but then this was July 31st, Fed Day. They cut the rates, but it was interpreted as one and done, maybe. Wham! They stepped all over it back in the 2,700 handle. Then we've had this kind of real tight chop in the month, not tight chop, but this inability to break out of these highs or these lows. These lows, some really nice looking swing lows down here at 28.10. Some really nice looking swing highs around 29.45 in this S&P market. So, I mean, in the month of August. But think about it. We had a range all the way up from 30.25, and they started it in late May, early June around Memorial Day, 27.30. That's 300-point range. That's about a 3,000 Dow tick range, and for good reasons. So there's your summer markets that just don't come to fruition because we had drivers. And if you weren't prepared for that, you were surprised, you got your face rearranged. It's all about what's driving the markets, what could come out to make us bullish, bearish, bearish, bullish. Just like today. Today's Tuesday, September 3rd, first business day of the month. We get ISM. It comes out pretty bearish, big miss in the 40s. They hit it, but then there was some sharp fades and rallies because, hey, maybe they're going to do 50 basis points at the next meeting. And then you bring the Fed back into it, right? U.S.-China trade news kind of took a negative spin because they can't come up with a date in September. So let's roll on this slide here. I don't want to review too much of what happened because it already happened. But the drivers are U.S.-China trade, FOMC 1 and 2. Biggest moves have come from the Fed going from neutral to dovish, dovish to maybe hawkish, back to dovish, and everything else. Remember the FOMC tool to see where they are. 90% right now, they're going to do a quarter, September 18th. There's now a 10% chance they might do a half. Watch as that moves around. Hong Kong became something that was worrisome for at least a couple days there, and how China was going to react to it. That's kind of settled back. But then the ECB and Brexit started to surface as drivers. At least they got in the car. ECB with how are they going to, how dovish with their QE at their next meeting, September 12th. And then Brexit jumped in the car last week with Prime Minister Johnson, maybe a good chance at finally getting Britain to leave, the UK to leave the European Union and create some certainty from all the uncertainty that's gone along with that story the last 3 years since they voted to leave the EU. What's important is the dates on this stuff, right? So the dates coming into September we're supposed to have a September meeting, but now there's this big question mark coming out of the Labor Day weekend, which has created some bearishness in stocks, right? FOMC, we know the date, and it's 9/18, 17 and 18. 18 is 1 o'clock Central's when they release their statement. You always check to see where the Fed is as far as what they're going to do percentage-wise, but this is the date that they make their decision and subsequent statement on rates. We know that. Hong Kong is pretty much, don't have a date attached to it, and off, but did keep us busy for a week or so then during the summer markets. Brexit and the ECB. Well, tonight, as a matter of fact, this isn't going to help you if you watch this video in the future, but tonight we have, not tonight, UK time, but Central time, there's going to be a vote that could move us, could be a dud, not even affect us. But the vote is, are they going to vote to delay the Brexit 3 months? That's baked in that they should be able to pass that. If they don't, that's actually bullish if they cannot pass the delay. I don't know how bearish it'll be for stocks if they vote to delay it because it's a little priced in. But prepare yourself for it. 3:30 Central, about the time that they commence on this vote. And then I think the Prime Minister, but do some research yourself, has a plan B to avoid the delay. And the whole thing about Brexit and why it's resurfaced is because they have the best chance to actually, if you look at the UK, let's look at this, the UK and then the EU is, and I talked to a couple UK guys in the room, this negotiation is like this guy right in here, U.S.-China trade. They're going back and forth. Obviously, the UK wants to leave. They voted on it 3 years ago, and there's just such a state camp that in the UK, let alone the EU, wants them to stay, right? So they go back and forth, and it's Boris Johnson. A lot of people I talk about from over there, it's a much better chance at actually executing what the people voted on 3 years ago than Theresa May. A lot of people think she was bad at either negotiating or getting everything done because she was from the state camp, and then she had to negotiate to leave. It's a big mess for a couple, 3 years. So anyhow, the reason why it becomes more, something that it jumps in the car again to drive the market is because you turn uncertainty into certainty. You finally get past this, right? And the pound is going to be the market to watch that's most sensitive to good news or bad news with this story. So keep that in mind as you're trading. Pull up a 6B as in boy. That's the futures, the pound versus the dollar, to get a good sense of Brexit. ECB 9:12 in the morning, U.S. time, is their decision on interest rates and their press conference with Draghi. So it's really important for 9:12 for you to be in front of your screens at 6:45, and then at 7:30 Central time when they have the decision on rates, 45 minutes, their press conference that whips the markets around an hour before we open. That's a week from tomorrow, I think. Right? No, from Thursday. That's right. They always come on Thursday mornings. So it's a week from Thursday, 9:12. So we got the date on the FOMC, 9:18. We got the date on the ECB, 9:12. This Brexit tonight, and then any subsequent votes, you got to stay on top of that. And then the question mark is, when are they going to meet again? That's the thing I want to talk about, not talk about, but underscore the most in today's meeting is the fact that, hey, the next headline could be and might be a date that U.S. China now have agreed on September X to meet. They got together, and contingent from China is going to come to Washington September 20th. That headline, if the markets are open in front of your screen, should be very knee-jerk bullish. Don't let that surprise you when it crosses the wire. I think that's the next bullish move for stocks, headline-wise, certainly from anything U.S.-China trade. If you notice, the market, when I bring this chart over again, did most of its movement on Fed activity, right? Look at how pivotal it was down in here when the Fed started pricing in to save the market that they were going to cut rates in their July meeting, which was still, 2 months from this point. Then they rallied all the way into that Fed meeting, and then they had their biggest break from up here to down in here when it was, hey, mid-cycle, maybe one and done. That's the way investors interpreted it. Now you've got this box even though it's August, it was a pretty wide range, 29.45 all the way down to those 28.10s. It's quite a nice range, even though it's 1 month. They're trying to get out of it. I think a U.S.-China trade date and any dovishness from the ECB or the Fed would get us just be very careful trying to sell it next time up to this area, because it could be a very up and away moment in that market with that kind of pattern. All right. So that's number one, why the summer was so busy, why the fall should be as busy or pivotal, stop on a dime, reverse, bullish, bearish. It's important in faster markets to manage your risk even more effectively, faster price moves, faster you have to think, faster you have to cut your risk, take winners at times, but know what the hell's driving the market. Put yourself in a position to make an effortless trade by going click, click, click. You're long 3 times the size you're used to, and you have 4 times the winner you're used to because you're in a good spot. That takes skill, though. It takes skill. It takes patience. It takes timing to just, put a bunch of size on and have it go your way right away. And it's all about reaction. What my goal was earlier this year and late last year was to hear more people that would make their month, make their week, make maybe their day on a big trade off of news. And we've got that. And not from a lot of people, but from a good half dozen people that have come to me and said, I caught that, or I caught this, or I turned my day, I was short, got long, made a ton of money. And so it was like, wow, that's trading. That's a big part of trading. And in the past, those people didn't even stand a chance to take advantage of that opportunity. And now you are. And that's sometimes the biggest opportunity. But you got to know if the rubber band's stretched after the news comes out. All right. So let's move on to guests coming out this month and next month, because I think you're going to like next week, which, by the way, our Tuesday meeting next week will be Wednesday. September 11th, 9/11 will be Dr. John Kepler, not and Anthony Credelli, just Dr. John on Tuesday, 9/11. Or I'm sorry, Wednesday. I say Tuesday, 9/11 because 9/11 happened on a Tuesday. Dr. John's going to be with us a week from tomorrow. So I will send out a reminder that the meeting next week on Tuesday will be instead Wednesday, maybe a different time. Either way, I'll record it for you guys that can't make it. Don't worry. But what we talked about, and I think he gets it, but what are some basic value area plays that he feels a lot of novice profilers take so that we could create hey, there's a lot of profilers long here and they're wrong. That's what's important. So he's going to show some things. Then I could ask him some questions and kind of get to the point of, hey, what's a popular profile setup? So when the market rallies through here and comes back, all these guys, let's just say, buy it. And the market comes up a little bit and bam. So when it's down here, because there was a popular bullish profile set up here, let's say, okay, we know we probably got a lot of people long and wrong. And when there's too many people long, there's sellers, right? Too many sellers at this point or above this point, the market could continue to move lower, or this becomes good resistance now. Because market profile and volume profile have become very popular over the last decade or so. The way the internet has exploded and it becomes easy to find education, profile gives people the sense of, hey, there's some familiar terms in profile that they could begin to connect. So if this is the trader and this is trading over here, put a dome up, and how do you connect? How do you feel like, hey, I could do this? What are some things that some connective tissue? And a lot of times it's the language. If there's familiar language, I think in profile, like auction, right? Just a word profile, but you got auction, and then you got value. I think is a term that you could connect with markets. And there's some others that escape me, but I think that's why profile becomes popular early on in most people's trading endeavors, and a lot of people watch it. The weakness is it's terrible at when do I execute? Well, I'm not trying to get people to study profile. I'm not against trading it. All the win moments that we teach in here are about executing whatever strategy you're from. But what I'm trying to work on is trying to create, number one, a popular profile slash, volume or market chart that most people look at. Not guys like maybe John, not guys like Mark and Tom and some other good profilers in our room. I don't want their nicest looking profile chart. I want what the popular profile stuff is. But number two, then, where are they stuck and where's popular setups, right? Popular setups. And not when they're all long to get short, but when they're all long, where are they all long from? And then we could make a pretty accurate assessment that they're wrong. That's all. If you feel most profilers are long at this line and we're trading right in here, then it's easy to say these guys are starting to get nervous, right? And this could be resistance because they took some heat and now they're all sitting here trying to sell it. Either way, if we get to that point, it'll be a really nice thing to continue to work on. And John will talk about some of that stuff we could piece together again next Wednesday, not Tuesday, September 12th. You'll get a reminder about the change in the day and the time. Anthony Credelli, I don't know if you know him. I don't have a date set up with him, but he reached back out to me, wants to do something. He's with the CME, does CME radio stuff, TV stuff. And what's interesting about him is that he's got a ton of floor experience, but he's got a lot of experience interviewing a swath of people that I've seen, some talented people he's interviewed and some not so talented people he's interviewed. So I think he's got a lot of good feedback just by his conversations he's had over the last 10 years, plus his, floor background. So he's going to be with us. And then Ken Packard, I think you might like him the best. Many people might not even know who he is, but I think after you listen to Ken, you're going to like him. I know you're going to like him because he just makes sense. He articulates really well. And he's kind of that motivational guy, but he could attach it directly to trading because he's in the business. So you can listen to motivational guys that aren't in trading. I don't think they help you as much. Just like the next guy, Brett Steenbarger. I think you could talk to psychiatrists all the time. They're going to help you with your trading, but who better than someone who actually trades? And that's where Dr. Brett comes in. So these are just a few guys in the month of September and October, more or less in October, because I'd say maybe we get 2 in September, 2 in October. But this is just a reminder, if you're watching this video now or before 9/21, I've been asked to speak at this money show in Toronto on Saturday, September 21st. I'll send you guys some information. If you're close or around that area, most of you are not, I get it, but you could sign up, I think, to hear it. I think maybe to hear it remotely or watch some stuff. I think that is free. You don't have to pay for it. I'll send you out an email with that stuff. So hold off on signing up to anything until you get an email from me. If you're interested in not just, it's free. All of it's free, I think. But if you're interested in going or watching it remotely or whatever options they might have, I'll send some stuff out before September 21st. I think it's Saturday, September 24th, like in the afternoon. And it's going to be on, more of some general stuff that you guys have heard, certainly. But it's always good to kind of get reminders. And I think this group is not just traders, but investors and things like that. But either way, it'll be interesting. I'm looking forward to it. You'll get an email about that. So that's what not only to look forward to from guests or speakers, but then also from a driver standpoint, what we got going on. Let's go. As far as the drivers in the market, you guys cannot avoid or ignore what the hell's driving us and when something comes in and out of what's important. And that's all I wanted to cover for today, is to kind of prep you for next week and the change and what we're going to look at, profiles, what's driving us, and kind of a goodbye to summer, hello to fall, what Labor Day does. And don't worry about holiday markets and it being slow, because you can get burned when it's fast and you expected it to be slow and whatever else. It's always about the drivers that move us up, down, sideways. What's really important about today, though, is, and I'm cutting it short mostly because markets are kind of interesting and a little busy today, but the next headline could be, hey, they got a date on China US negotiations. Know what to do with that. All right. Know what to do. Check the FOMC, probability tool that they have as far as where they're at. Keep track of 90% a quarter, 10% now 50. Does that change over the next couple days? And how does it relate to stocks? That's what's important. You got stocks go down and that 10% camp goes up for a 50 basis point cut. Stock prices go up, then it's just a quarter cut. You know what I mean? It's going to be a quarter cut either way, but what percentage wants 50? Because that'll have a lot to do with their next meeting. Are they going to do a quarter, right? September, and then their next meeting it would be November. So know what's driving us, what dates are important to pay attention to, what comments are important to listen to. One last thing I didn't elaborate on that's important with this ECB, is one of the reasons why he got back into being important is one of their ECB governors from the Netherlands talked about not needing or having quantitative easing being necessary, which is hawkish in a sense. ECB has been very, very friendly to easy monetary policy over the last few years, right? Cut, QE, bond buying, and all this other stuff. QE was a phrase introduced in 2007, November of 07, to make rates even lower and money even cheaper than just lowering rates. It was actually central bank buying bonds to keep rates under pressure. So the markets would love, as spoiled brats that they are, QE. And so he mentioned last week that QE wasn't necessary and markets kind of got beat up, especially overseas. And then someone today kind of confirmed that. They knee-jerk went down and then went back up because it was in the market. So the ECB, that's what their stance is. Right now it's baked in that they're going to do a rate cut, but not really get too dovish on QE. If they start to get dovish on QE, and that was a source story earlier this morning, then we go up because of it. And you got to know why in a real timely manner. This EU source story, policymakers reportedly leaning towards a rate cut, tiering and reinforced guidance in the September 12th stimulus package. So they were dovish and the market reacted to the upside. And that was a lot of a pop, I think, to 08 at the time. All right. So that's relevant to not just now, but if you watch this video in 6 months, some of these things might not be relevant anymore. But the idea of what is relevant, find out what it is and what's going to drive the markets either north or south, because it's always going to be something. They might have a trade deal and it's out of the way. The Fed might be in neutral. This is long gone. Brexit, they already left. ECB is still, went and stayed dovish. So all of this is no longer relevant in 6 months, maybe. But there is a whole swath of new stuff that might be driving us that you can or can't predict. It's going to be the maybe U.S. election. We'll be in the heat of that in 6 months. Or it could be something that you could never fathom. I remember talking to one of our analysts when I was at the prop firm, and he said, because it was kind of slow. I said, what gets us busy? He says, that's the thing. You never know. You never know until it happens. And you're like, well, that's it. And it ended up being Hurricane Katrina and gold starting to rally through a big range that it had been stuck in for 20 years. Gold took off and crude oil took off. And then, and that was like '05 and '06. And then lo and behold, beginning of '07 was the financial crisis and the meltdown, the housing bubble and everything. And that became the huge driver. So don't try to predict what's going to drive us in 6 months. Just know what the hell is driving us when you're out there. And so no matter when you watch this meeting, this webinar, it's relevant. Just find out what's driving us. And don't worry about summer markets, because sometimes it's summer markets and sometimes, June, July, August, December could be the busiest months ever. August of 2011 was the busiest month I ever remember. So when the U.S. credit was downgraded by the rating agencies because they wouldn't extend the debt ceiling, August, September of 2011. September and October before that of 2008 was the climax of the financial crisis. So those were the two busiest months before August, September of 11. December of one year when the fiscal cliff was a big story. I don't remember what year that was, but that was around the holidays. May the holidays a big range momentum type market. So I hope today helped to keep your kind of minds reset. Summer's over. Get out of your suits, bathing suits. Wash off that tanning lotion. And get back in the car and don't try to make up for any kind of lost opportunities if you did miss some of the stuff in the summer. There's always another opportunity. There's always another tape bomb, as we used to call them, around every corner. Just know what it could be. So when you hear it, see it, you're not surprised. Therefore, you're able to react to it. Next week, again, Kepler, if you're watching this on a recording, it should already be uploaded, the Kepler event. For everybody else, make sure you manage your risk before you take it. Be safe. Markets start to move faster. Cut your size. These micros have been great for those not trading well or trying to really start to build confidence. I do a whole webinar on a lot of great stuff I've learned from these personal one-on-one coaching sessions I've done and the effect that those have had on those individuals and how important the micro has been to doing review sessions. People who couldn't trade because the ES becomes too expensive could just find that they're over trading. What a great problem to have when you were fearful to pull the trigger in one market and now you're pulling it too much in the other. Great problem to have, and the micros allowed that to happen because it naturally does what's so hard, and that is it makes this part a little easier to deal with, the mental part. I'll make that a brain. Because what does the brain always do? There's a huge connection between this money and your brain. And the micro has allowed people to strip that, don't trade the money, without stripping it out entirely, because it still counts, right? There's still some money to be made or lost. But you could trade like garbage and still learn something and not be beat up by losing hundreds or thousands of dollars. The other thing about the micro is it's in just the net. It's in other markets than the S&Ps, right? NASDAQ, Russell, Dow. But one other thing about it is so much better than sim. Sim market, it doesn't count. You don't have to fool yourself. You're going to do some things you wouldn't do if it wasn't sim. And if you have a good day, you're not that impressed, then count. You make 50, 100 ticks in sim. Really? You excited about that? You lose 100? You really that disappointed about that? No. The micro, though, gets you to feel a little bit of that good emotion when you're up and feel a little bit of that bad emotion when you're down without too much that it doesn't disincentivize you to review. All right. So good luck, guys. Keep an eye on these drivers. Keep coming to the trading room and make sure you're not missing too many days. Get a routine, whatever that might be. I'll post last week's video and this week's video shortly.